U.S. stocks drop for a fourth straight session as investors brace for Nvidia's earnings. Kevin Mahn of Hennion Walsh Asset Management joins me. Kevin, talk about the fears rippling through the markets one day ahead of Nvidia's earnings.
Sure, Lisa. The S&P 500, as it stands right now, is on track for its longest losing streak since August on fears of a potential AI bubble and perhaps fears over excessive valuations across the stock market in general. I think many are questioning at this point in time, how much longer can the AI infrastructure spend continue at its current levels? And they're right to question that. They're questioning the excessive valuations of some of these tech companies that are associated with the AI revolution in particular. And I think it's helpful to those investors to remember that this AI revolution will be a very long road filled with many potholes, and there will likely be more losers than there will be winners. However, if investors can identify those winners, and many of those winners will likely be those that have spent money already and continue to have the capacity to spend to stay ahead in the AI revolution, that will ultimately be the winners in the end. But they're going to have to practice patience to be able to achieve that. Of course, Nvidia sits at the hub of the AI ecosystem as I see it. And it's so important to the psyche of investors around not only the stock market, but of the status and the health of the AI revolution overall. But they're not the only company that stands to benefit from the proliferation of AI in society. I contend that investors should still look to the AI infrastructure spends now and ultimately the AI benefactors and implementers down the road.
So they're not the only company, as you point out, but Nvidia, as you also point out, is so key to investor psyche. What will you be looking at most closely in tomorrow's earnings?
Yeah, I believe in all likelihood, Nvidia will knock the cover off the ball once again as it relates to quarterly earning, likely exceeding analyst estimates in terms of earnings per share and revenues. I believe they may even guide higher in terms of their forecast for the next quarter and maybe even for 2026 overall. I'm still looking for a healthy blend between chip revenue and data center revenues, remembering that last quarter, the data center component of their business accounted for 88% of their revenues, whereas the chip business, which they're mostly known for, only accounted for 12%. But I don't think all of that matters. I don't think it will meet the expectations of investors. I believe that even though their earnings and their forecasts will suggest to me as a portfolio manager that the AI revolution is still alive and well, many investors will still question if there is an AI bubble and when that AI bubble is about to burst.
Among other earnings this week, Home Depot reported today and forecast a bigger drop in full-year profits, sending its shares down. Are we finally starting to see the resilient consumer show strains?
I believe that we were starting to see strains in the consumer earlier this year, as we remember that 70% of our economic growth in our country comes from consumer spending. Yet, the contribution to overall GDP of consumer spending was matched by the investment made in AI infrastructure during the first half of the year. So, Lisa, was it more that AI infrastructure spending was that strong, or was the consumer starting to weaken? Now, we've seen the consumer pick up a little bit during the third quarter, as evidenced by the 13.1% year-over-year earnings growth rate of the S&P 500 overall. But Home Depot certainly does give reason for pause. Now, obviously, Home Depot can be influenced not only by the consumer, but also on the real estate business, the cost of mortgages, and if in fact consumers are continuing to upgrade their own homes and do their own do-it-yourself projects. So I'm going to wait to see how other consumer staple companies fare this week, whether it's the likes of Walmart, Target, or even Lowe's, a strong competitor to Home Depot, before I start to give up on the consumer just yet.
With the S&P 500 trading below its 50-day moving average on Monday, some are predicting an overall pullback for stocks. What is your overall market outlook?
Sure. Generally, anytime the S&P 500 or any stock market index for that matter falls below its 50-day moving average, it is cause for concern, as generally that's an indicator of a shifting momentum downward in future stock prices as opposed to upward. Of course, The even bigger indicator would be if it crossed its 200-day moving average, because that would be the infamous death cross, and that would suggest that perhaps an even bigger correction according to historical standards. But we also need to remember that October marked the 3-month anniversary of the current bull market. And if I go back over the last 50 years, Lisa, what I know and what I've seen is that there have been 5 other times when a stock market has hit its 3-year anniversary in terms of a bull market. And in all 5 instances, the market continued to move higher by an average total duration of 8 years, which would suggest we still have 5 more years to run. The lowest duration was 5 years, which would suggest we have 2 more years to run. And in 2 of those instances, we even hit double-digit years in terms of the total duration of the bull market. Now, of course, this time could be different, and past performance isn't indicative of future results, but I do believe there's multiple tailwinds that would support a continuation of this bull market run, but that won't be without more short-term bouts of volatility. And I think there will be more volatility ahead in the fourth quarter, although that volatility will likely be greeted by money coming off the sidelines later in the year and giving us a nice little Santa Claus rally to finish out the year on a high note.